March 5th. And it's flip-flops weather in Denver. I mean, it's like 70 degrees, it's I mean, it's beautiful. But also, Barry Bailey, I see you. It's also a little scary, isn't it? I mean, we want to
Yeah,
get some
it is.
moistures.
We're
Get
going to
some
pay the
moisture.
price come summer. Yeah, for sure.
Indeed. Yeah. Yeah, I've stopped praying for powder and shifted to praying for rain. Right at this point. It's too late for powder. Anyway, thanks for being here. I'm Tim Quast with Market Structure Edge, and along with me is Brian Wilson, market strategist. And I'm going to go first. We'll keep this focused. And if you're wondering again, we're working on stuff and we might do this in the next 2 weeks with, you guys know the pre-market prep guys. So they want us to host these on their stock trader network so that we have some more exposure. And we might do that. So there's a better reach. We don't have a partner right now because we ended our partnership with IBKR. They're skinflints, and we walked away. We pulled a Taylor Swift. If you're not going to pay us to be on Spotify, of course she's big, we're not doing it. So yeah, and we're in discussions with somebody else, and I'll keep you posted on how that goes. But anyway, I'm fine with it. We're patient. My topics for today is, first of all, take gains, not chances. It's one of the first things that I talked about. Those of you who, like you, Barry Bailey, you've been around a long time. It's a trope. It's musical, it's easy to remember, but there's a reason why we say it, and I'm going to share my screen. Let me just refresh here. Give me 5 seconds. Okay. Okay, John, let me see. I see the questions too. Let me make sure that I address that. Okay, where are we? There. Okay, so John, I missed that. I'm waiting for it to load. There it is. IGV. Brian's good at that stuff. Okay, so that's some of the. Okay, like app. Okay, in fact, I'll do that. So I mentioned Circle, and Rich, I think you were here. You dropped me a note about that. This is the take gains, not chances notion that I'm talking about. When when the market becomes volatile, and how would we know that that's going to happen? Well, I'll walk you through that too. But in conditions like these, where you don't know what's going to happen throughout the day, I just return to the idea of these simple daily trading ideas. And you really shorten your time frame, your exposure to risk. I think it's best under these conditions. It's not the only way, but I'll explain again why it tends to work well. But in the last 10 minutes of the day is when you take a position in one of the daily trading ideas stocks with the intention that somewhere near to the open, I mean, you could wait, but why do it? Somewhere near to the open, you take your 2% gain. Remember, that's the whole point. The idea of this math is that stocks that are 3% or more volatile in a market that has 2% underlying, I'm simplifying, it's 3% right now. The whole market has very elevated volatility, that if you follow the model where there is diverging demand and supply, the probability that you can take a piece of that volatility as a gain is very high. And if you could do that in 5 minutes, you're going to write it out overnight. That's pretty good. Why does that work? Well, there are opening and closing auctions. Passive money needs the reference price into the close. I don't know how that's going to work when we will inevitably go to 24/5 or 24/7 trading. You're going to have some way for indexes and ETFs, index funds that have to offer the same price to everybody, can have a reference price, but it works because of that and because of 0 days to expiration options. I mean, they're a full options life cycle all day. And so into the close, that stuff really accelerates. In fact, I'm counting on it. I'm counting on one of these days, the market taking a big dive in the last hour, which causes volatility to spike, and you can profit on that. It's not something that you do as a rule. It's a highly exceptional thing to do, and it's risky because you don't know. But certainly, we can see what volatility is and know with some degree of comfort how things are going to behave. But that sure takes the stress out of it. What happens overnight. Yes, something could happen. There's no question. News. I think Dan Niles, who was on CNBC as I was coming up here to do this, and I met him a long time ago. We were both young and tight-skinned at the time, and he's a smart guy. And he said it's less the news than what happens in reaction to the news. I mean, why is it that news sometimes has an impact and other times it doesn't? Because the market is an automated system. I mean, most algorithms, the market's virtually 100% algorithmic. It's 100% electronic. Most of the order flow is automated. There's a continual flow that's occurring within risk management parameters, and those things consume information and they make adjustments. And whatever the model says is how the market will behave. It is not rational. We all talk about it. But the rational input into the market is the smallest part. It's 10% of volume. 90% of the market is a different purpose and time horizon. So coming back to the central idea here is take gains, not chances. If we don't know what direction the market's going to go, then trade high probability things for small gains in short increments. Into the close, out at the open. Opening auction, all kinds of stuff trying to affect the VWAP into the close. And that whole time decay of delta and gamma hedging in 0 days to expiration, it's going to break down at some point, which is my next quick thing. How do we know that this market doesn't have any direction? Well, look at demand. It's not going anywhere. It is at 5.2. Technically, that's positive. But if you go down to the supply side has risen, peaked, and risen again. I mean, those conditions tell us, well, the market does not have a good signal. Well, what do you do when it doesn't have a good signal? Don't commit more money to the S&P 500, for instance, and trade your short-term opportunities because volatility is elevated. That to me is one of the best ways to think about this. Going to an example. I just highlighted Circle, which is already out, I think. I guess I didn't look. I'm out. Right? So you could stay in it, but you could look at this and go, well, all right, reported results, huge short covering. Is that all the gains? No, there's a huge demand supply divergence. There's a lot of demand. It's banging against the ceiling at 10. We just normalized to a 10-point scale. It's an algorithm, meters trade executions, and tells us which way things are going. It's a pretty good mathematical read. Supply is short volume. It's kind of the supply chain of the stock market. And if that drops, there's a good chance of gains. And then it's leveling off. So again, I'd say that's why it's out. So it's no longer got a downtrend on the supply side. But you can use that over and over in virtually any condition, and it works pretty well. So. To the broad market. This is my last little thing, and I'll hand the baton to you, Brian Wilson. When I think about how the market may rupture, I tend to be early. I tend to be way ahead of time. And it's not that I don't worry about it, but I just look at broad sentiment. And I've said all along that if you let's go all the way a year back to this original snapback outside of the pandemic. This was this extreme bounce in the market. And then if you looked at how prices behave, that gives you a lot of ability to carry. There was excess supply too, because there was so much demand that there wasn't enough stock available. So market makers short, and they're going to have to cover that, and they did. And then you hit a point right at options expirations where the market dips and recovers, a snapback. It's small there, I realize. The little one right at the August-September transition, another one here. This to me was the big event. This is where I thought, okay, second shoe could drop. There'll be something else like this that'll develop, but it hasn't, right? It hasn't as of yet. Now I'm going to zoom in, but keep that in mind. So October, so let's go look at 6 months. And this is why you look at demand and supply in the market. What are the trends? How's it playing out over time? So here's the big snapback. That's what we were just looking at. Market took off. Another dip here with November expirations. Here's where, I mean, I made a whole bunch of money and gave it all back. I had a volatility bet and a short bet, and I made like $50,000, $60,000, and it went away because I was out of the country. So it's the risk of those things. I went in eyes wide open. I understood the risk. I knew what the market looked to me like it was going to do. Another snapback, yet another one here, in early February. And then now, this is no snapback. Okay, whatever happens next, what we can draw from that is the behavior that has persisted since Liberation Day has changed. I always say if flows change or there's a break in the arbitrage mechanism that keeps that delicate balance of stocks, baskets of stocks, ETFs that track them, and options that trade on both, all that stuff has to be within measurable standard deviation. In a large portfolio for any index fund, you don't want more than 15% standard deviation typically, meaning things in my basket should not move more than that either side. Over a large group of stocks, that's not a whole lot. I mean, the volatility of the S&P 500 right now over a month tallied is 70%. So you want to keep standard. What happens when that changes? Well, now machines don't know how to calculate prices. How does Citadel make bids and offers in thousands of stocks, ETFs, and options if the prices become unstable? Well, they may stop doing it in some of them where the model says we can't predict how to place a bid or offer or whether to be long or short. And that's what creates volatility. Well, we've got all those things. So that tells you right there that you need to be short in your time frame, take gains, not chances. I think one of these times we're going to break below 4. Is it this now? I don't know. But this is how I look at the market. Okay, that's my 15 minutes, not of fame. Over to you, Brian Wilson.
I had the same thought. 15 minutes of fame. That's terrific. Well, like Tim, just a couple of topics today. Great to see you guys. We always appreciate checking in with you guys. I wanted to start off with that example that I noted in the market desk note this morning on IGV. So software stocks have been in the news. They've been getting killed. Let me show you what it would help if I shared my screen, right? Every once in a while I do that. All right, so we'll pull up IGV, and you can see really from end of December going forward, just getting absolutely destroyed on a 6-month basis. I don't have that. It's down about 20% on a 6-month basis, but it was in the news, software basically every single day, and you catch these rhythms sometimes in the market where things are in the news a lot, and you're like, wow, is this ever going to find a bottom? Well, what you can do is you can create your own portfolios on these. So what I did for software, and I mentioned this in a previous meeting, is I created a portfolio with the 10 largest companies, just drop those in there, and watching supply and demand. So, when does supply and demand tell me that, that we're near a bottom? So I mentioned in the note this morning, I think I made my first purchase this is an ETF, just a way to get exposure to the industry. I made my first purchase right in there. I made my next one right in here. So it was more of a longer term holding. So there's different ways that you can approach this, right? You can do the daily trading, and you can have a 1 or 2 day holding period. I knew with this holding period, this was going to be more of a value investment, longer term holding. So I bought some in here, and then I just waited, and it bounced around at during the rest of February, but you can see what sentiment has been doing in the meantime. And then I bought some more with yesterday's trading, but you can see the current setup. Why is software one of the few spaces that is higher today? Well, you can see it very clearly. Demand up, short volume low. So for an entire industry, it's basically lifting an entire industry, just as Tim showed earlier with individual stocks. When you do get names that are in the news, recognize that these things run in patterns. It feels like they're going to be for sale forever. And when I'm talking to clients, I have a few software clients, hard discussions, very hard discussions. They feel like they're getting run over. They're getting a lot of pressure internally, but recognize that the flows will change at some point, and obviously they're starting to change right now. One way that you can get a hint at some of this activity, and I have a number of watch lists, and I don't watch them, minute by minute. I look at them every 10 or 15 minutes. But I'll look at this has top 30 names or so on it. And I'll look at the names and what's going on today? What's green, what's red? And I noticed that like, oh, what's going on? The market was lower a couple of days ago. Some of my software names were up. I was like, why are they up today? So it catches your attention, and just watch what the money's doing. It's very, very difficult to hide buying activity. And you can see today with the market down 1.2% on the S&P 500, IGV's up about 2%. So there's, supply and demand, working out, real time in the market for you. I wanted to show you and Candace had asked a question, what's happening with the news? Why is the market down one day? Why is it up, another day? What I'm showing you here, this is the SPY, so the ETF side of things. Don't worry about all the numbers. I'm just going to show you three things. So lead behavior each day this week: fast trading, passive investment, and risk management. That's on the ETF side. Look on the S&P 500 side: passive investment, fast trading, fast trading. So recognize what those behaviors are. That's model-driven behavior. What does it tell us? It tells us that models are reacting to news. So news comes out, it gets a sentiment score. The machines, fast traders, are going to react to that. Passive money from a quant fund aspect is going to react to that as well. Sometimes it'll get a positive sentiment score. Sometimes it'll get a negative sentiment score. And for instance, with today, you get a negative score, and and things unfold and no buyers show up, and then the bottom just falls out over the course of the day. But recognize it's once again fast traders and quants that are reacting to these news events. And just like we're seeing today, we're going to have up and down days. It's just the reality of where we're at right now. Now, in the middle of this, you're still going to have pockets of divergence, and I'll give you a couple of examples here. So if you look, and I have a number of portfolios, but I was scanning them before the call. I'm like, where are we seeing divergence right now? You can see it very clearly in communication services. There's demand that's higher. There's short volume that's moving lower. Take a look at the financials. Somewhat similar. Demand not quite above 5, but you can see that short volume trend as well. And then you look at what has been moving. I always get stuck up here at the top. What's been moving recently in the markets. Look at 2 out of the top 3 for the last week. I just showed you communication services and financials. Those are 2 out of the top 3. What did they have in common? Good divergence. Obviously, the financials were a little bit below neutral, so it didn't have the same gains as communication services, but you could see the same trends were in play for each one of them. Feeding off of what Tim said earlier in terms of the kind of the road ahead, things I'm watching. Similar to Tim, it just shows what the models are doing, right? If you're in the middle of war in Iran and sentiment kind of grinds to a halt, that's very telling. it tells us that active investors are certainly not, playing on that news. We saw that with the daily trading for all the behaviors, and we can see short volume doing the same thing at this particular time. Here's a thought in terms of a watch list item over the next few days. Maybe drop it in a list. Watch the interaction between SVXY and UVXY. Normally SVXY will not move more than 1% lower on a given trading day. I would not be surprised at all if that one is higher at the start of the day tomorrow. I've shown you UVXY before in the past. These tend to be very violent, very quick moves when it does move lower. So that concept of take gains, not chances, very, very true when you get 14, 15% moves lower. In terms of the overall road ahead, we're going to be dominated by news for quite a while. We're going to be watching to see whether short volume moves below neutral or not. And as Tim mentioned earlier, if sentiment moves below neutral or not. And, let's watch what happens from this short volume trend. So expect choppy overall trading. It's not going to be a linear path moving forward when we're in this type of a news environment. That's what I have for today, Tim.
Okay, thank you very much, Brian. Sorry, Joe. I was replying to your question. So to clarify, it's an expectation, not a strategy. My strategy has been to trade volatility. I've been, since this snapback didn't work. So once the market did not snap back, there was big volatility to start February. February was the most volatile month since April. It's in some ways it was every bit as volatile. You don't see it in the movement of the VIX and some other things, but in the construction of the market, the volatility is extraordinary. You may have been hearing people talk about dispersion. That dispersion in equities is at 20-year high, could be record highs, meaning stocks are not behaving similarly. So Joe, that feeds into, well, what am I going to do? I see that I'm going to trade volatility because it comes back to knowing what I know. I know that 90% of the assets in the market are in are in large cap stocks. There's not a whole lot of them. 140 of them are 75% of the market or more. Number two, 100% of the net flows. I'm not talking about the fact that T. Rowe Price is buying stocks here or selling them there. If you take a long step back and look at the demographics of the market, 100% of the flows, call it a net 400 billion to the equity market, the U.S. equities, is in passive models. And as Mike Green says, passive money deploys capital, period. It doesn't sit around and go, well, is that a proper multiple to pay? It just has money that has to go to work, and it tends to go to large, liquid, stable things. We're just finishing a project for a big insurer along these lines. Is it superior to be value or growth? And there's an answer to that from a strategic standpoint if you're deploying shareholder capital. So those things I think about, Joe. And so if I know that the models need stability, they can't have tracking errors. Meaning, if I have a basket of stocks that says it's tracking the whatever, the S&P mid cap 400, and my model is not tracking that, I'm in trouble. And so it's why they skew toward large caps. Go look at some of those. Go look at IWM. Several of its largest holdings are $100 billion stocks. Why is a mid-cap fund holding $100 billion stocks? Because they're more stable. I'm less likely to have standard deviation in the model. All right, I know these things to be true. So then when there's dispersion in the market like we've got, I know that models are going to have trouble. And if the models have trouble, they will stop rebalancing. You can kind of see it in the data. That's a change to flows. And if the flows change, then all the machines that are setting all the prices may not know what to do. And that's a rupture in the arbitrage mechanism. I don't know if it's going to happen. It might never happen, but the probability is high, and it has to happen under these conditions. And so in these conditions, I have increased my short exposure, and I've certainly increased my volatility trade. But these are short-term things. I mean, if the conditions change, let's say flows normalize, volatility comes back into alignment, things cohere again, and stocks begin to behave the same way. How are we going to see that? Well, we'll just look across your dashboard. In fact, I'll do this. I've got 1 minute, and I'm going. Here's what I mean. You can go look in the same way that you would go look for divergences for whether they are everything's behaving the same way. Well, it's not. You know. Just look at, there are 10 stocks in low volatility. The supply side's very rugged. Usually they move kind of the same. Like, the supply side moves down and demand stays at 5 in low volatility. That's what it's supposed to do. This has even been lumpy. I mean, this is the safest place to trade right now because I look at that and go, well, that's pretty predictable. Look at mega caps. The supply side is very volatile. Demand is barely at 5. The market depends on these. And if you just look at all the lines, are they alike or different? They're all over the map. You can't go and look at airlines and AI and in my 75% short portfolio and buy fives, which is just a model looking for things at 5 that have declining supply. It's principally financials, but they're all over the map. Okay, well, if there's no clear direction, that's a telling feature, and I know that I can trade volatility. And I think a lot of the time it shows up in the supply side. You have wavy lines on the supply side, and we've had them since late January. And sure enough, we've had much more volatile markets. And so when that changes, then I will drop this trade. My hope is that it will pay off. I'm not advocating this as a strategy. I'm sharing it because it's what I happen to be doing. I say take gains, not chances, trade daily trading ideas. The model portfolios under normal, I'm not in them at the moment because in anything, I don't want more exposure to equities right now. I think there's downside risk. Doesn't mean it's going to happen. And again, if it mean reverts, then I'll return to doing that. Right now, I think it's an opportunity for this and maybe a pretty big return on a volatility event. And Joe, to conclude that thought, what I mean is, if the market's going to dive, it's going to happen in the last hour because that's where everything needs a price, whether it's 0 days to expiration and settling out a trade where there are 2 sides to it. You're trying to hedge the rate of decay and the changing prices, both delta and gamma. And it's 1 day trade. Well, what if you just throw in the towel? Oh, man, the 60% of the S&P 500's volume. And if models aren't deploying capital, I'm playing a probability that could happen, that we have a 5% or more drop into the close on a day. And how will we know that risk is past? Well, this will normalize. I mean, I think if we settle out here, we go a number of days at 5-ish, then it's not going to happen. Or this thing drops and we finally drop below 4. And we're again at a point where I think that there's a high probability. The biggest probability was in November and it didn't happen. So we'll see. That's what I'm looking at. That's kind of my next view. So Brian, concluding thoughts?
Tim, one follow-up question there from Joe. He's asking whether you buy and sell UVIX each day, depending on the convergence read. And if supply is up, is it time to buy volatility? So just kind of a follow-up question there.
I'm not at the moment, but that is what you should do. That's absolutely the best way to play it. If you get you can get a 15-20% return in a day in that thing, and you take that and you immediately do the opposite. And that has been a very effective trade here lately. I have increased it right here just because we're at a nexus. I just think, the next thing in the cadence of the market is quarterly rebalances 2 weeks out. Well, everybody's thinking about it, right? These people running big models who are running risk management schemes, they're all thinking about this stuff. And do you make your moves beforehand? Well, maybe. Because you don't want to get caught in some kind of directional change there. I think it's an issue. So For this particular moment, I'm willing to, I'm willing to let it ride a little bit more, but you have to have the stomach for that because you can see your portfolio go up and down a lot when you're playing a volatility trade. And it's not for the faint of heart, nor is it a good investment strategy. I am not, I'll repeat this over and over, advocating that you do this. But if you ask me what I'm doing, that's what I'm doing and why. As a rule, yes, should be a one-day trade. I mean, if you get a 7 or 8% return or double digits on a volatility trade, take the money because the next day it might give a lot of that back. Like yesterday, 11, 12%. Well, it's a great time to buy that volatility trade again because you know the conditions that created it have not changed. So what's the probability you can get a return doing that? Only if you understand market structure. This is knowing what the math is telling us. Demand's at 5.2, could decline. Supply it's 52%. There's no cohesion in the market. We've got big quarterly rebalances coming up. Flows have changed. Volatility is 3%. These are all conditions that they're not conducive to putting capital to work. They're conducive to short-term behavior, and so that's what I'm doing. Okay, we'll see how it changes. If it's all changed by next week, then we're back to normal. So we'll see. Okay, I'm off to Steamboat. There's supposed to be a big storm coming, Barry. Like a foot of snow. I'll believe it when I see it, but we're going to, beat a hasty retreat from the warm temperatures back to the mountains ahead of that. So see you next week.
Colorado 70 today and snow tomorrow.
Exactly. Exactly. Good to see everybody. Take care. Catch you next week.
Take care, you guys.
You
See
too.
you guys.